How to manage risk with barrier options. If you are curious about managing risk with barrier options, you are in the right place. Let's break down how these unique financial instruments can help you control your exposure in options trading. Barrier options are not your typical options. Their payoff depends on whether the underlying asset's price crosses a specific barrier level during the option's life. This unique structure can be beneficial for managing risk. First, it is essential to understand the two main types of barrier options. Knock-in options activate only when the underlying asset hits the barrier level. Before that, they hold little to no value. On the other hand, knockout options become worthless if the barrier is breached. Knowing which type you are dealing with helps you anticipate when the option will become valid or expire worthless, guiding your risk management decisions. Next, choosing the right barrier level is crucial. Setting the barrier price too close to the current stock price increases the risk of activation or deactivation. A barrier set further away reduces the chance of hitting the barrier but may increase premium costs or reduce leverage. Barrier options typically have lower premiums than standard options. This lower cost can limit your upfront capital risk while still allowing you to maintain exposure to the underlying asset's price movement. Monitoring the underlying price movements closely is vital. Since the value of barrier options depends on crossing the barrier, you should actively track the stock price relative to the barrier level. Be ready to adjust or close positions if the underlying approaches the barrier, based on your risk tolerance. Combining barrier options with other strategies can also be effective. For instance, pairing a knockout option with a standard option can help hedge against adverse price movements while still capturing upside potential. Consider the time to expiration and market volatility as well. Shorter expiration periods reduce the chance of hitting the barrier, which can lower risk. However, higher volatility increases the likelihood of crossing the barrier, affecting your risk exposure. Some barrier options come with rebate features. These pay the holder a fixed amount if the barrier is hit and the option expires worthless. This feature can help reduce potential losses, so it is worth considering in your risk management strategy. Understanding the definition of a barrier event is also important. Clarify what it means to cross the barrier, as this can affect your risk. Precise definitions in the contract can prevent unexpected outcomes. Limiting your position size is another effective strategy. Since barrier options can expire worthless if the barrier is breached, keeping your position size manageable helps contain losses if the market moves against you. Lastly, employing analytical tools can provide additional support. Use valuation models and simulations to estimate the likelihood of barrier events and potential payoffs. This quantitative insight can guide your risk management decisions. In practical terms, managing risk with barrier options means balancing the lower premium costs and conditional payoffs against the possibility of the option becoming worthless. By carefully selecting barrier levels, monitoring market conditions, and integrating barrier options into diversified strategies, you can control your exposure and protect your capital effectively.